On the evening of April 7th, Donald Trump announced a ceasefire with Iran. The very next morning, Wall Street exploded. This chart tracks the immediate aftermath. The S&P climbed 2.5%, the Nasdaq jumped nearly 3%, and the Dow logged its best single session in almost a year. The traditional financial press quickly labeled this a relief rally, claiming investors were celebrating a return to global peace. But maritime intelligence firm Windward paints a completely different picture. They use AI to cross-reference digital GPS signals with satellite imagery to track actual global shipping. This map displays the Strait of Hormuz. Before the conflict, a baseline of 130 ships transited this choke point daily. But by midday of the market rally, satellite radar detected only 5 outbound carriers. That is a 96% drop in physical shipping traffic. The physical supply chain remained completely paralyzed. There was no actual peace to celebrate. Wall Street's record-breaking day was driven by something entirely hidden from the public eye. 6 weeks earlier, on February 28th, joint U.S. and Israeli airstrikes hit Iran. Tensions escalated, the Strait of Hormuz was shut down, and the S&P plunged nearly 9% by the end of March, its sharpest losing streak in years. Panic set in. Commodity analysts projected that a sustained closure of the strait would remove 15 million barrels of global oil supply daily, potentially driving Brent crude to $300 a barrel and triggering a global economic depression. To understand how Wall Street reacted to that panic, we have to look at data from Goldman Sachs. Their prime brokerage desk services the largest hedge funds in the world, giving them a direct view into what these institutions are buying, selling, and betting against. This graph illustrates Goldman's internal tracking for the first quarter. It shows hedge fund short selling hitting its absolute peak, the highest level recorded since April 2020. Alongside those massive negative bets, gross leverage, the borrowed money these funds used, sat dangerously high at over 300%. The smart money was heavily positioned for a total catastrophe. They had borrowed billions to bet against the global economy, turning the entire market structure into a highly unstable, tightly coiled spring. Here is how that trap was set. This flowchart outlines a short trade. A trader borrows shares of a stock and immediately sells them. The goal is to wait for the stock's price to drop, buy those shares back at a discount, return them to the lender, and pocket the difference. But if the stock price goes up instead of down, the trader is caught. Because they eventually have to replace those borrowed shares, they are forced to buy them back at a higher price. And if the stock keeps climbing, the potential losses are theoretically infinite. When those losses reach a critical threshold, the broker steps in with a margin call. This is a strict demand to either deposit more cash immediately or automatically buy back the shares at the current inflated price to close out the debt. This mechanism dictates the physics of the market. A margin call forces a trader who bet heavily against a stock to become an aggressive, immediate buyer of that exact same stock. On the evening of April 7th, that ceasefire headline crossed the wire. It generated a small, initial pulse of optimistic buying when the markets opened. Because hedge funds were stretched to 300% leverage, that tiny upward pulse was enough to push their short positions past the breaking point. The brokers issued the first wave of margin calls. Suddenly, these deeply underwater hedge funds had to buy back millions of shares simply to survive the morning. That abrupt surge in buying demand pushed stock prices even higher. Those higher prices triggered a secondary, much larger wave of margin calls for the next tier of short sellers. They were then forced to buy, which spiked the price again, setting off an aggressive, compounding loop. In finance, this mechanical chain reaction is called a short squeeze. Trapped hedge funds were forced to buy at any price to escape their collapsing bets. This massive wave of forced buying provided the mechanical energy needed to push the market to record highs. This surge in human-driven buying then activated a larger, automated layer of the market. As the short squeeze propelled the S&P and Nasdaq vertically, the momentum pushed those indices directly through key technical price barriers. This tripped the sensors of commodity trading advisors, or CTAs. These are massive automated algorithms that execute billions of dollars in trades based purely on momentum. They do not read geopolitical headlines or watch the news. This visual maps their behavior. Once the S&P crossed that upward threshold, the CTA networks woke up. automatically executing massive buy orders simply because the mathematical trend was pointing up. This algorithmic flood of capital supercharged the final phase of the rally. Meanwhile, out in the physical world, the Strait of Hormuz remained paralyzed. The ships were still gone, and the global supply chain was still broken. This episode highlights a market capable of running on its own internal logic, a machine driven by leverage and algorithms that can drift far from the physical reality on the ground. When a single headline triggers these mechanics, the market ceases to be a reflection of the world and becomes a self-reinforcing glitch. On April 8th, news of a ceasefire provided a ready-made narrative for the day's market activity. Traditional reports suggested that human optimism over the peace deal drove investors to buy stocks, pushing the S&P 500 into a sharp rally. The data behind that rally, however, reveals a scale of capital movement defying simple explanation. Over just 5 trading sessions, buying volume hit $86 billion. This chart tracks the fastest buying speeds in the history of the stock market. According to Goldman Sachs, the activity on April 8th represents one of the top 5 buying speed prints ever recorded. A typical human portfolio manager operates by analyzing earnings reports and modeling future cash flows before making a discretionary decision. Executing $86 billion in coordinated trades across just 120 hours suggests a process far more automated than human deliberation. This is the image people still have of the market, a place where humans make decisions based on the perceived value of a company. In reality, that human-centric market has been replaced. To understand the $86 billion surge, we have to look at the automated systems that now dictate the movement of capital. One layer of this automated market is controlled by commodity trading advisors, or CTAs. These are systematic trading firms that run on rules-based models. They operate by following price trends, regardless of news cycles or geopolitical developments. Before the ceasefire, a downward price trend had led these algorithms to accumulate a $30 billion net short position, essentially betting that the market would continue to fall. The S&P 500 eventually hit a specific mathematical trigger level. At that exact threshold, CTA models immediately exited their short positions and flipped long. They automatically bought back their shorts and purchased additional equities, totaling tens of billions of dollars in a single move. This buying occurred because price thresholds were breached, which in turn activated the next layer of market architecture. That activity moved directly into the options market, which now accounts for approximately 63% of all S&P trading through same-day expirations. Institutional dealers on the other side of these trades must maintain a delta-neutral position to manage their risk. When customers buy call options, dealers hedge their books by buying the underlying stock in real time. Leading into April 8th, data platforms identified a condition known as a negative gamma regime. This flowchart illustrates how dealer hedging changes in a negative gamma regime. Instead of stabilizing the market, hedging becomes pro-cyclical. As the price moves up, dealers are forced to buy more stock, which pushes the price higher and triggers further buying. The sudden buying from the CTA algorithms pushed prices into this feedback loop, forcing options dealers to add their own massive volume to the rally. These rapid reactions sit on top of a massive structural foundation: passive index funds. Today, 63% of all U.S. stock funds, roughly $13 trillion, is held by passive indexers. This capital flows on autopilot, following the index without evaluating company fundamentals. Because most of these funds are market cap weighted, they are mathematically required to buy more of a company as it gets larger, creating a default allocation that ignores valuation. High-leverage hedge funds add further pressure. These funds often operate with strict drawdown rules that trigger immediate automated sales the moment a loss limit is reached, bypassing any human debate. On April 8th, these forces stacked on top of each other. The initial short squeeze triggered the CTA flip, which fed into the dealer hedging loop, all while the massive passive fund bedrock maintained its automated allocation. The rally followed the internal logic of these automated systems, operating independently of the news events used to explain it. This sequence is a recurring structural event that has been observed multiple times over the last decade. In December 2018, a single word from Jerome Powell, patient, triggered a similar algorithmic cascade. The resulting rally led to the Dow's first ever 1,000-point gain in a single day. The same mechanism appeared in August 2024, when a Bank of Japan rate hike caused the yen carry trade to unwind. The resulting volatility saw the Nikkei drop 12% in a single day, only to bounce back by 10% the following session as the automated systems reset. While the headlines and the catalysts for these moves change, the underlying mechanical reaction remains consistent. The traditional concept of the stock market, where long-term valuation and human analysis dictate price, no longer drives the majority of market action. The dominant forces in the modern market are reactionary. They are systems designed to respond to price changes with further buying or selling. The global market has become a real-time feedback loop, where algorithms, passive funds, and options dealers react primarily to one another. The headlines provide a narrative for a move already dictated by market structure. They allow observers to rationalize the outcomes of these complex automated processes. To understand the mechanical truths of the financial system, rather than the simplified narratives, hit subscribe. We focus on the actual drivers of the modern market.